the Feds aren't going to be cutting rates later this year. In fact, they're more likely to raise rates, period. You're going to see why we're all going to be blindsided by the Feds later this year. And in fact, you must give Fed Chair Powell a round of applause for pulling it off so smoothly that no one saw it coming. So earlier this month, March, the FOMC meeting, Chair Powell, the Fed board, they said they foresee 3 rate cuts later this year. But they're staying put right now. Nothing's being done. They merely foresee. Now, if you're reading between the lines, they really don't know what's going on. They merely foresee, and it's as likely to change as the direction of the wind. They're not committing to anything. So I'll share with you why Jay Powell's 3 rate cuts this year is really a farce. Inflation's not done. That ugly demon is going to rear its head again, and probably again and again for quite some time, more than we would ever expect before it's really over. It's going to get ugly before it's over, in fact. And the truth is, the Fed really doesn't have control of anything. They merely respond. If you remember back in 2021, they said, inflation is transitory. And we all saw what happened, and we're still seeing what's happening right now. So you can see right there, the Fed doesn't have control of anything. They don't actually know the future. They can merely respond to the future. So what they say here and now today for what they're going to do later on, it is as certain as the direction of the wind today. And that changes often. Am I right? Now you're wondering, why am I saying the Fed is not going to cut rates and more likely to raise them when everyone out there is saying they are going to cut rates, rates are going to go down? In fact, I think that's what everyone's hoping, and that would be ideal, but there's so many more reasons for inflation to rear its head again and again and again and again that we're more likely to see rate hikes from the Fed than for them to cut them. For starters, there's Russia and Ukraine. That's been going on since 2022, and it's only heating up more and more. Recently, they've been hitting Russia's oil refineries, causing a spike in oil prices. And that seems like it's going to continue despite the U.S. wanting Ukraine to stop. So we're going to see gradual increases in our everyday lives as the cost of fuel starts increasing more and more because of what's going on. And then there's France. They're thinking about sending their troops on the ground in Ukraine, and France is a NATO member. So there's a lot of things that could go wrong with that. More likely to lead to other things, the U.S. coming in, the rest of NATO coming in, and it's really a test of NATO, but that's a different story. Then there's Israel in the Middle East. It seems like it's Israel against the whole Middle East for the most part, and that doesn't seem like it's abating anytime soon. And from there, because of that war, it's affecting a lot of the shipping lanes, causing a lot of ships to have to go a different route if they're not already. Some of them are still trying to go through the Red Sea, but most of them probably aren't because they're very at risk of the Houthi striking the ships. Even with the British Navy, US Navy, and a lot of Western powers there, they're not able to stop the Houthis. They're still launching a lot of rockets and attacks at a lot of the ships that are passing by that area. But most important of all, I want to look at the US economic data, some of the money supply and GDP. So we're going to look at that right now. Let's look at M1, the money supply, how much money is out there. You can see ever since COVID, skyrocketed. And regardless of what's been going on the past few years with the rate hikes, it has barely made a dent on the money supply. We have a long way to go to get to pre-COVID. But of course, we're not trying to get to pre-COVID. But even then, we're nowhere near cutting that money supply back. And I don't think we ever will. We can only put a lid on it, pause it, and let it go on flat for a few years. And I think that's the best case scenario. Now, my point there showing you this M1 chart of the money supply is so you can see there's a lot of dry powder out there that can easily trigger inflation again. And because of this, I think it could be very inflationary for him to lower rates and everyone rushes out the door and start deploying their capital, instantly triggering inflation all over again. So why would he lower rates and increase money supply? I mean, you can look at where we are right now with the money supply in this M1 chart. Next, we're going to look at M2, the velocity of money. How often is it changing hands? How much movement is there in that money from that money supply? Usually taken by looking at GDP and the money supply. That's how they find out what is the velocity of money. So here we're starting to see how much the money is circulating, how much it changes hands, or is it used to purchase goods and services in the economy. So you can see here, it's really not changing hands much. In fact, it's going down. So there's a lot of money on the sideline, a lot of dry powder. Again, that could kick off very easily. In fact, they're seeing there's no reason to enter yet because rates are still high. In fact, I think that is one of the goals of Jay Powell is to keep rates high to keep this money on the sideline. Otherwise, it starts being deployed and there is not enough goods out there for all the money on the sideline. You saw on the M1 chart how much money supply has shot up. And you can definitely tell we haven't produced that much more to make up for such an increase in such a short period of time. And in fact, that is the very reason why we are having inflation. So there you have it. You see that M1 chart and the M2 chart, and you're seeing there's a lot of dry powder on the sideline. There's so much money out there chasing so little goods. Thus, inflation is very easy to happen, especially if he does actually go through with cutting rates. And here's an economic theory perspective to piece it all together. If the money supply increases significantly while economic transactions, the GDP, doesn't keep pace, the velocity of money would decrease since more money is chasing the same amount of goods and services. Then you have the GDP. It's been up for the past 2 quarters. It's been doing well. So there's really no reason for him to lower the rates and heat up the economy when the economy is already doing well. So why would he go ahead and cut the rates? I don't think he will. And next, we have the debt. That is definitely skyrocketing. Debt and deficit. Debt is the amount of debt that's been piling up that every citizen owes on behalf of the government. And then deficit is how much more the government is spending than they are earning. You could see, oh, the debt is massive. And then the national deficit is massive as well. So that spending does add to the economy and increases inflation. That's putting more money out in the economy. And it really does warrant higher rates if we're going to continue having inflation. So on one hand, the Fed is doing one thing to try to lower inflation. But on the other hand, the actual government is increasing spending and deficit, which is by definition inflationary. And I do believe Chairman Powell does want to make it more painful for the US government to continue this endless spending and borrowing so that it's painful enough where Congress decides to have an adult conversation on how to address this continuous deficit and this piling debt that keeps going on. So why does Chairman Powell say things he knows he may not even act on? Frankly, because he can't. And we're seeing the powerful effect of his words. We're seeing a massive bull run in the stock market, in the crypto market, just because he said we're going to go ahead and cut rates later this year. But like I said before, what the Fed does is as certain as the direction of the wind tomorrow and next week. They can change at any time. But the powerful thing is the fact that he can have the same effect as if there was a rate cut and have everyone start piling into the market as they're doing right now. And honestly, I think when he does a rug pull, that's a great way to clean out some more capital from the market, from the money supply. And that is something Chairman Powell does want to do. He truly is the master of the universe. Now, what it certainly does accomplish is it covers behind the scenes of all the bankruptcies that are going on, all the layoffs across America. Zombie companies are dying, office buildings are hollowing out. He actually does, he as in Jeremy Powell, does want losses because that will hold off the inflation that can easily rear its head. You already saw the money supply. I think that picture is more than clear enough for you to see why inflation is so easy to happen and continue happening. So he wants losses, even though he can't say it out loud. It would be unpopular. It would be unpolitical. People will show up at his house with a pitchfork, essentially. He wants accounts wiped out. He wants less money out there so he can shrink the money supply. And that is really what they should be doing. And he is getting a lot of crap from businesses, as you can see. And perhaps the most tricky reason is because the Fed does have a dual mandate to keep unemployment low, meaning maximum employment, and inflation as low as possible. So right now, he's definitely handling and working on the inflation part of it. And he can continue working on that part as long as unemployment is still manageable, it's not skyrocketing. And that certainly is the case right now. So I think he's still going to continue attacking the inflation issue. And that's why I really think he is going to do a rug pull and actually raise rates and cut out a lot of capital later this year. So that's something to really be careful about. And if you're deeply invested, just look out and be careful. So what should you do with all that? I would say avoid anything that is hype-based type of asset. Things like cryptocurrency that's shooting up high because everyone's plowing their money back in, expecting massive inflation due to Jeremy Powell's rate cuts that I don't think are ever going to happen. I take that back. Not going to happen this year. It is going to happen eventually, of course, but it is going to be higher for longer than most people expect. So cryptos may shoot up very high, but when the Fed's hand is truly revealed later this year, it's going to be decimation. I would say stay stable, stay in real estate. It may be shaking a bit, but it won't be crashing. There isn't any rate cut based hype that is inducing sales right now, although steel prices are still creeping up. It's actually a long-term base investment with actual need. That's why I believe it's very stable and we're not going to be seeing a crash with it. Real estate assets are still going up. You saw that dry powder that was on the sideline. So that is how it's going up. A lot of people were holding back and now they're starting to feel more comfortable buying. Plus, something I went over in a previous episode, the government is going to start getting to housing more and more. They're going to start leasing buildings. They're going to start giving more money to people as in tenants to rent, and you can get a piece of that action if you own something. So that's why I recommend real estate, something that is stable and won't be crashing down once the Fed does its rug pull, the pie in the face for everybody, and you're still safe with something stable like real estate. Overall, stay prepared. It's definitely going to be a pie in the face when the Feds raise rates later this year. It's going to get ugly real quick. But as with all storms, that too shall pass.